Investors with a long-term view on their portfolios will more than likely want one thing: a strong passive income stream in retirement. And how do we do this? Well, the number one way we can do it is dividend stocks, particularly dividend growth stocks. My name's Dan from stocktrades.ca, and in this video I'm going to be covering some of Canada's best dividend growth stocks. These might not necessarily be the highest yielding stocks, but they're going to be stocks that provide you with strong dividend growth and, more importantly, compounding dividend returns. If we want to build an investment portfolio that in retirement we don't have to touch the principal, or in other words, simply live off the dividends, dividend growth stocks are absolutely critical. I have a large chunk of my portfolio allocated towards dividend and dividend growth stocks, and as investors transition through different career stages, different ages, it's very likely they'll transition to holding more and more of these stocks until that's essentially the only stocks in their investment portfolio. I'm just going to jump straight into the video today. We're going to speak on 3 Canadian dividend growth stocks. The criteria for making this video: they had to have at least a double-digit 5-year annual dividend growth rate. They've had to have raised dividends for at least 5 years or more, making them a dividend aristocrat. And they have to have a payout ratio in terms of earnings of under 60%. And a payout ratio in terms of free cash flows of under 50%. So I spent a total of probably 45 seconds finding these 3 stocks this morning. And the way I can do it so efficiently is simply with our dividend screener over at StockTrades. We track over 200 Canadian dividend stocks. We have 1 and 5 year annual dividend growth rates, dividend growth streaks, payout ratios in terms of earnings, free cash flows, operating cash flows. And our screeners have saved people hours of research. If you're looking to create a pinpointed short list of income stocks, dividend growth stocks, even pure play growth stocks, our screeners will save you a ton of time. If you want to check us out, head down to the description below, sign up for free. Now, on to our first stock, which is Equitable Bank. They trade under the ticker EQB.TO. Equitable Bank is one of Canada's top alternative lenders. They have a yield of around 2.16% at the time of filming this video, and they have a 5-year dividend growth rate of 13.66%. With a dividend growth rate like this, they're essentially doubling their dividend in just over 7 years. Now, in terms of payout ratios, Equitable Bank has an extremely low payout ratio. It's around 12.3% at the time of filming. And in terms of cash flows, we're actually not going to speak on that. Looking at cash flows in terms of payout ratios for financial institutions will probably end up confusing a lot of new investors, as they often operate with negative operating cash flows. And this is primarily because they are loaning money to consumers. Before the stock market crash, Equitable Bank was trading in the $110 range. And right now it sits at around $67. At its lows, the company actually dipped into the $45 range, which just shows you how much this stock market crash was based on pure fear and sell-offs. Now, the outlook for the Canadian economy does not look good. So why do we like Equitable Bank? Well, for one, they're all digital. And this is something we feel is really going to catch on moving forward. People spending more time at home than in the office. And we expect this transition to affect the banks as well. So Equitable Bank is a Schedule I bank, and they have been told they are able to continue paying dividends, but dividend increases must be put on hold. Most all of the major financial institutions in Canada were told this, and it is unfortunate because before all of this started happening, Equitable Bank had one of the fastest growing dividends in the country. As most companies tend to raise dividends every year, keeping their yearly dividend growth streak alive, Equitable Bank had raised dividends for 6 straight quarters. This is more than any other financial institution in the country. Management has also stated that they would like to increase the dividend by 20 to 25% on an annual basis. A 20 to 25% annual dividend increase means on the high end of things, the company expects to double the dividend every 4 years. The company started paying dividends when they initially went public in 2004, and they paid an annual dividend of 24 cents a share. The share price back then at $23, this is just over a 1% yield. If you were to have purchased the stock back then, your yield on cost right now would be around 6.43%. This yield on cost shows that not only is Equitable Bank increasing its dividend at a rapid pace, but its share price is also increasing. As of right now, Equitable Bank is cheap. On a forward earnings basis, it's trading at only 5.64 times earnings. Now, the second quarter is when we will see the full impacts of COVID-19 on the Canadian financial institutions. So there is a chance that analysts will be downgrading estimates But overall, the company is an excellent dividend growth option. And with such low payout ratios, even in an economic downturn, although possible, the company is very unlikely to cut its dividend. It would have been very interesting to see if this COVID-19 pandemic hadn't happened, how many consecutive quarters Equitable Bank would have been able to raise the dividend. So moving on to our next stock, and this is one company we feel will still be able to increase the dividend during the COVID-19 pandemic, and that is CCL Industries. They trade under the ticker CCL.B. They're a manufacturing company that makes packaging and labels for a wide variety of industries. Now, the company is one that a lot of Canadians have never heard of, and it is primarily because their product line is straightforward and simple. They are sizable, there's no question about that. The company states they have over 21,000 employees and they operate over 180 facilities in 40 countries. The company's stock price did take a significant hit during the market crash, and it was relatively unwarranted. I mean, this company produces packaging and materials for some industries right now that are in heavy demand. Consumer packaging, healthcare, electronic devices, and automotive markets. Now, the company did just post first quarter results, and on a year-over-year basis, earnings are relatively flat, which typically would be something that you wouldn't want to see. But considering we're in the middle of a pandemic right now, a lot of investors are actually happy with flat earnings. Revenues of nearly $1.3 billion are around $40 million shy from last year, but diluted earnings per share are actually up from 69 cents to 70 cents. And in terms of balance sheets, the company has a very healthy one. With around $2.15 billion in current assets and $1.25 billion in current liabilities, the company has nearly $1 billion in working capital. And if you aren't exactly sure what working capital is, it is simply the company's current assets, which are assets the company can quickly convert to cash within the next 12 months, versus current liabilities, which are liabilities that are expected to come due in the next 12 months. In terms of assets, think the company's inventory, their current actual cash, and in terms of liabilities, think accounts payable, like bills that are due, and even debt that is payable over that 12-month period. Now, one thing we like is the fact that CCL is putting this working capital to use. The company has made 6 acquisitions in 2020, and most all of these companies are based internationally in the UK or the United States. Considering their last acquisition was in March, before the pandemic really hit hard here, we would expect the acquisitions to slow down, but it's definitely a positive sign that the company is putting cash to good use. So in terms of dividend numbers, CCL is approaching nearly 2 decades of straight dividend growth. The company has raised dividends for 18 straight years, and they have a 5-year dividend growth rate of 25.32%. This essentially means that the company is doubling the dividend every 4 years. And its most recent increase was actually over the 30% mark. In terms of earnings, the company is paying out around 26%, and in terms of free cash flows, just under 28%. The dividend is healthy, and it will be really interesting to see if CCL can continue to raise it in the future. The yield isn't that high, it's only 1.59%. The real thing to consider with CCL Industries is its huge dividend growth. The company started paying a dividend back in the mid-90s. It was trading around $2.10 a share, and it paid a 5.6 cent annual dividend. Fast forward to today, the company has a forward annual dividend rate of around 72 cents annually, which equates to a massive 34% yield on cost. Overall, unlike our first stock, Equitable Bank, which is going to be forced to maintain the dividend, we really feel that CCL Industries has a good chance of actually being able to increase its dividend moving forward, just because of the industry it operates in. Now, the third and final stock we're going to talk about, one that is in the technology sector, is Enghouse Limited. And Matt has spoke on this stock in our top technology stocks to buy. I'll leave a link at the top of the video here and down in the description if you want to watch that video. But Enghouse is one of the best technology stocks to own today in terms of dividend growth, especially if you're looking to earn a passive income stream through compounding dividends. Now, unlike Equitable Bank and CCL, which are still trading at discounts relative to their 2020 highs, Enghouse has been the beneficiary of a surge in popularity in tech stocks during this pandemic. The company is trading well above 2020 highs, and valuations are pretty high right now. On a forward price to earnings basis, the company is trading at 36.2 times forward earnings and around 8.1 times book value. But if you are looking to get exposure to the tech sector, which we feel should almost be included in every single portfolio now, and you're also looking for dividend growth, there's no better than Enghouse. The company has a 13-year dividend growth streak, 5-year dividend growth rate of around 17.19%. This means that in just over 5 years, the company will have doubled their dividend if they keep this same growth rate moving forward. In terms of free cash flows, the company only pays out around 28.75%. And in terms of earnings, their payout ratio sits at just shy of 40%. Now this 5-year dividend growth rate of around 17% is fairly impressive, but even more impressive is that over the course of Anghouse's 13-year growth streak, they've managed to grow the dividend by 10% or more on an annual basis in every single year. Now, not only are you getting dividend growth with this tech stock, you're also getting capital appreciation. Anghouse's stock price has risen by 33% annually over the last 5 years. And pandemic or not, this stock seems to continue to deliver, as it is already up around 22% year to date, which is significantly outperforming the TSX index. Anghouse provides software solutions to large companies and also has a very diverse base of clients. They take care of networking software, customer service solutions, and logistics software for companies in the utility sector, the banking sector, the telecom sector. They have a very wide product base and customer base. And even though Anghouse does look expensive right now, it's actually trading significantly lower than its peers. Stocks like Kinaxis and Shopify have extremely rich valuations right now due to substantial growth from these companies, but the one thing that Anghouse has that they don't is a dividend that is growing at a rapid pace to go along with some excellent growth in terms of stock price. Year over year revenues are up 28.6% and net income has saw a 7.8% increase. The company is seeing a significant increase in subscriptions in essentially all of its platforms except its hardware segment, which makes up very little revenue. And it's important to note that the company essentially has zero debt. This is going to give them a ton of flexibility moving forward in terms of acquisitions and increasing the dividend. In the past, technology stocks have often been thought of as speculative and high risk in nature, but we really feel moving forward that technology stocks are actually going to become somewhat of a defensive option in every Canadian investor's portfolio. One last thing I would like to mention is if you do want more information on Anghouse, head down to the description, sign up for a free membership over at Stock Trades Premium. We do develop custom research reports for members. We actually made one on Anghouse not too long ago. It only takes a couple seconds to register and it's got a lot more information on the company than just in this video. Overall though, that's it for the video. I primarily focused on dividend growth. Equitable Bank will be more volatile moving forward just because of the uncertainty in the Canadian economy. And we can expect CCL, because of their product line and the industries that they offer it to, should see less fluctuations in their revenues moving forward. But it is never a guarantee as we are in unprecedented times. Most of all, subscribe to the channel, like the video, and drop your comments below. What stocks are you looking at today? What do you want our next video to be on? And stay tuned next week so you don't miss any more Canadian investment content. Till next time.